All right, so today let's look into options.
Options. Yeah.
Yeah, you shared chapter 20 from a corporate finance textbook with me, and
Yeah.
we're going to do a deep dive on that.
Yeah. Cool.
So think of this as your crash course on options.
Okay.
Not just the lingo, but like how this stuff connects to like the big picture of how companies work, debt and equity and all that.
Yeah, it's fascinating how once you understand options,
Yeah.
you just start to see them everywhere in finance, like even just in the way companies have structured themselves.
Yeah, exactly.
Yeah.
So before we get to the corporate stuff,
Yeah.
let's make sure we're on the same page about the basics.
Okay.
What is an option?
So an option is like, you can think of it like a get out of jail free card, but in finance.
Okay.
And it gives you the right, but not the obligation to buy or sell something at a set price in the future.
Okay, so it's all about having a choice.
Yeah.
Not being locked in.
Precisely.
Yeah. Okay.
Now, there are two main types of options.
Okay.
Calls and puts. So a call option is like betting that something will go up in value.
Okay.
So you buy a call if you think the price of something like, say, a stock will rise above a certain level.
Okay.
A put option is the opposite.
Ah.
It's like betting that something will go down in value.
Okay.
So you have the right to sell at a specific price.
Right.
So if the price falls, you can still sell at the higher price that you locked in.
Got it. So with calls, you're hoping the price goes up.
Yeah.
With puts, you're hoping it drops.
Exactly.
But what if the price doesn't move the way you expected?
Well, that's the beauty of options.
Okay.
You are not obligated to buy or sell.
Oh.
If the price moves against you, you can just let the option expire
Okay.
and walk away. And your only loss is what we call the premium that you paid
Right.
to buy the option in the first place.
Oh, okay.
So yeah, there's a whole bunch of terminology we need to kind of unpack.
Yeah, like strike price and expiration date.
Exactly.
What's all that about?
Okay, so the strike price is the set price at which you can buy or sell the underlying asset. Think of it as like the target price you have in mind.
Okay.
The expiration date is the last day that you can exercise your option.
Got it.
So it's like the deadline.
Okay.
Then you've got American and European options.
Okay.
And no, it's not about geography.
Gotcha.
American options can be exercised anytime up to the expiration date,
Mm-hmm.
whereas European options can only be exercised on the expiration date itself.
Oh, okay. So American options give you more flexibility.
Exactly.
Okay. What about this premium you mentioned? What does that mean?
So the premium is the price you pay to buy the option.
Okay.
It's basically the cost of having that get out of jail free card.
Wait, so you have to pay for the option?
Yes.
It's not just about buying or selling the underlying asset.
Exactly. And on the other side of that trade, someone is selling that option and collecting that premium.
Oh.
They're taking on the risk, hoping that the option will expire worthless, so they get to keep that premium without having to actually buy or sell the asset.
I see. So options trading isn't just about the underlying asset. There's this whole separate market for the options themselves.
Yeah.
Interesting.
Yeah.
Can you give me like a real world example, like something not about like stocks and bonds?
Sure. So let's say your favorite band is coming to town
Okay.
and tickets are expected to sell out fast.
Okay.
You could buy an option to purchase a ticket at a set price, let's say $100.
Okay.
If the band becomes super popular and tickets are selling on the secondary market for like $200,
Yeah.
your option lets you buy it at $100, and then you can either go to the show or sell the ticket and make a profit.
Yay.
But if the band's popularity fizzles and tickets are going for $50,
Yeah.
you could just let your option expire.
Okay.
And your only loss is that premium you paid.
Okay. That makes sense. So options are like having a backup plan.
Yeah.
A way to manage risk or capitalize on an opportunity.
Exactly.
Okay. But how do you actually make money with these things? How do you
Yeah.
know what they're worth?
That's where understanding option payoffs comes in.
Okay.
And we can actually use some charts to visualize how much you stand to gain or lose at different price points for the underlying asset.
Charts. Okay, I can handle charts.
Yeah.
So walk me through how this works for both calls and puts.
Okay, so let's imagine a scenario where you buy a call option
Okay.
with a strike price of, let's say, $100
Mm.
for a stock that's currently trading at $95.
Okay.
What happens next?
I don't know. You tell me.
Well, if the stock price stays below $100 by the expiration date,
Yeah.
your option expires worthless.
Okay.
You lose the premium that you paid,
Mm.
but that's it. Your losses are limited.
Okay.
But if the stock price goes up, say, to $110,
Okay.
you can exercise your option, buy the stock at $100,
Right.
and immediately sell it in the market for $110.
Oh.
So you make a profit of $10 a share minus the premium that you paid for the option.
Okay. I see the potential there. But
Yeah.
Isn't this just gambling?
Well,
You're basically betting on whether the stock price will go up or down.
it's true that there's an element of speculation involved, but options can also be used for what's called hedging,
Okay.
which is all about managing and reducing risk.
Okay.
So, for example, if you own a stock and you're worried about the price dropping,
Okay.
you can buy a put option.
Right.
If the price falls, the put option gains value, offsetting your losses on the stock.
So it can be used offensively and defensively.
Exactly.
Okay, that's cool.
Yeah.
So let's go back to the payoff diagrams you mentioned. We can visualize this.
Yes.
How does that work?
So imagine a simple graph
Okay.
where the horizontal axis represents the stock price at expiration,
Okay.
and the vertical axis represents your profit or loss.
Okay.
For a call option, the payoff line would be flat below the strike price,
Okay.
reflecting that limited loss of the premium.
Mm-hmm.
Then at the strike price, the line would slope upward,
Okay.
showing that your profit increases as the stock price rises above the strike.
Okay. What about a put option?
The payoff diagram for a put option would be like a mirror image.
Okay.
So the line would slope downward below the strike price, showing increasing profit as the stock price falls, and then flatten out above the strike price, representing that limited loss of the premium.
Okay, so these diagrams really help visualize
Yeah,
the potential outcomes.
exactly.
But you mentioned something earlier about long and short positions.
Yeah.
What does that mean in the context of options?
So it's all about which side of the trade you're on.
Okay.
When you buy an option,
Yeah.
you're taking a long position.
Okay.
You're hoping that the price will move in the direction that makes your option more valuable.
Gotcha.
When you sell an option, you're taking a short position.
Okay.
You're hoping that the price will move against the option holder so that the option expires worthless and you get to keep the premium.
Got it. So long means you're hoping it goes up in value. Short means you're hoping it goes down.
Exactly.
But it seems like the risk is much greater for the seller, right?
It can be.
They could potentially lose a lot more than just the premium.
Yeah, that's true. Selling options can be riskier, especially if you're selling what are called naked options, meaning you don't actually own the underlying
Yeah.
asset.
Right.
Yeah, the potential losses can be significant, but there are ways to manage that risk, like using strategies that involve buying and selling multiple options simultaneously.
So it's like a whole other level of
Yeah,
complexity and strategy.
yeah, definitely.
But before we go there, I want to go back to something you mentioned earlier.
Yeah.
This idea that options can be applied to more than just stocks.
Yes.
What did you mean by that?
So option contracts exist for all sorts of things, not just stocks.
Oh.
You can have options on indexes like the S&P 500,
Uh-huh.
on currencies like the euro or the yen,
Okay.
even on commodities like gold or oil.
Wow. So you can basically create a get-out-of-jail-free card for almost anything.
Pretty much, yeah.
That's amazing. But I have to admit,
Yeah.
all this talk about options is starting to make my head spin a bit.
Yeah.
Is there any way to connect all these pieces together?
Yeah.
Like some underlying logic that ties it all together?
There is.
Okay.
There's a fundamental concept called put-call parity,
Okay.
which shows how the prices of call options put options. The underlying stock and a risk-free bond are all interconnected.
Okay. That sounds a bit intimidating.
Yeah.
Can you break it down for me?
Sure. So let's imagine that you want to protect yourself from a stock price falling below a certain level.
Okay.
You could do this in two ways.
Okay.
First, you could simply buy a put option, which gives you the right to sell the stock at that price, even if the market price falls.
Okay.
Second, you could buy a call option and a risk-free bond.
Okay.
The bond guarantees a certain return,
Mm-hmm.
and if the stock price rises, the call option gains value, offsetting any losses you might have if the stock price falls.
Okay, so two different ways to achieve the same goal.
Exactly.
Where does the parity come in?
So according to put-call parity, those two strategies should have the same payoff at expiration. In other words, the price of the put option plus the stock price should equal the price of the call option plus the present value of the bond.
Okay.
If this relationship doesn't hold,
Yeah.
there's what's called an arbitrage opportunity,
Okay.
meaning traders can exploit the price difference to make a risk-free profit.
So it's like a self-correcting mechanism in the market.
Exactly.
If the prices get out of whack, traders will jump in and bring them back into balance.
Yeah, they'll bring things back into equilibrium.
Okay, that's pretty cool.
Yeah.
But we've been talking a lot about theory.
Yeah.
Can we look at some like real-world examples
Sure.
of how this stuff actually plays out?
Absolutely. Remember that eBay option table we were looking at earlier?
Yeah.
Let's dive back into that
Okay.
and see how factors like strike price time to expiration and volatility actually impact option prices in the real world.
Okay. I'm always a fan of seeing the theory
Yeah.
in action.
All right, so take a look at these eBay options Quotes from February 21st, 2022. The stock price that day was $54.71.
Okay.
Now notice how call options with lower strike prices
Yeah.
have higher prices.
Mm-hmm.
This makes sense because the right to buy a stock at a lower price is obviously more attractive.
Great. The lower the strike price, the more potential for profit if the stock price goes up.
Exactly.
What about put options?
The reverse is true for puts.
Okay.
A higher strike price makes the put more valuable because it gives you the right to sell at a higher price, even if the market price drops.
Okay. That's pretty straightforward. What else stands out to you?
Well, notice how for both calls and puts, the longer you have until expiration, the more the option is worth.
Okay.
This is because time gives you more flexibility. American options can be exercised at any time.
Mm-hmm.
So the longer you have that right, the more opportunity you have to profit from price movements.
So time literally translates into value in the options world.
Exactly. And here's another interesting observation.
Okay.
You'll notice that option prices are most active when the strike price is close to the current stock price.
Huh.
These are called at-the-money options.
Okay.
And they attract a lot of trading activity because they offer the most potential for quick profits if the stock price moves in either direction.
Got it. So these are like the sweet spot of the
Kinda, yeah.
options market.
Yeah.
Okay. This eBay example is really helpful for understanding how options work
Good.
in practice.
Yeah.
But let's move on to our next big topic,
Okay.
the early exercise dilemma.
Ah, yes. This is where things get a bit more nuanced. As we mentioned, American options can be exercised any time before expiration.
Right.
But here's the catch. It doesn't always make sense to do so.
Okay.
Sometimes it's actually more profitable to hold on to the option or even sell it in the market.
So it's like having a superpower,
Ah.
but knowing when not to use it.
Precisely. And one of the factors that can complicate this decision is dividends.
Okay.
Let's look at some real-world examples to see how this plays out.
Okay. Give me the real world dirt.
All right. So back in December 2005, General Electric stock went ex-dividend, meaning anyone buying the stock on or after that date wouldn't receive the next dividend payment.
Okay.
Interestingly, the day before the ex-dividend date,
Yeah.
some of the call options on GE were actually worth more if you exercised them early and captured that dividend.
So in that case, you're actually getting like a little bonus
You are.
by exercising early because you were able to snag the dividend payment.
Exactly.
Makes sense. Wasn't there an example, though, where early exercise wasn't the best move?
There was.
Okay.
So let's look at Google in July 2018.
Okay.
At that time, Google wasn't paying dividends.
Okay.
And it turned out that early exercise was actually the worst move for put options on Google stock.
Okay.
You were actually better off selling the option in the market rather than exercising it.
Ah, so the presence or absence of dividends
It makes a big difference.
really changes the game.
Yeah.
It's not a one-size-fits-all
No, it's not.
situation.
Wow.
But how do you know when to exercise early and when to hold on?
Right.
It seems pretty complicated.
It is. There's no easy answer.
Okay.
It depends on a variety of factors, including the stock price, the strike price, the time to expiration, the volatility of the stock, and of course, whether the stock pays dividends.
So you really have to weigh all the potential benefits
Yeah.
and drawbacks before making a decision. It's like playing chess. You got to think a few moves ahead.
Exactly. And speaking of thinking strategically,
Yeah.
are you ready for a mind-blowing revelation about how options connect to the structure of companies themselves?
Mind-blowing. Always lay it on me.
All right. Prepare yourself a company's capital structure.
Okay.
Its mix of debt and equity
Yeah.
can be seen as a portfolio of options.
Wait, what?
I know, right?
How is that even possible?
Think about owning stock in a company.
Okay.
You're essentially buying a call option on the company's assets.
Okay, Melissa, explain how that works.
So if the company does well
Yeah.
and its assets increase in value,
Uh-huh.
your stock, which represents your ownership in those assets, becomes more valuable. You participate in the upside. But if the company goes bankrupt,
Yeah.
your losses are limited to your initial investment.
Right.
You don't have any further obligations to the company's creditors.
Right, so with stock, you have limited downside risk,
Exactly.
but unlimited upside potential.
Yeah.
Just like a call option.
Just like a call option.
So what about debt?
Okay.
Where does that fit in?
Debt holders are in a more interesting position.
Okay.
It's like they own the company, but they've sold a call option on it.
Okay.
They get the steady stream of interest payments,
Yeah.
kind of like collecting that option premium.
Mm-hmm.
But if the company really takes off, their potential gains are capped by the face value of the debt.
Right.
They don't get to participate in that explosive upside
Yeah.
that equity holders enjoy.
So debt holders are like the option seller's content with a more limited but
Right.
hopefully steady return.
Yeah.
But they're also exposed to more risk if the company goes bankrupt, right?
Exactly. If the company's assets fall below the value of the debt,
Yeah.
the debt holders are first in line to claim those assets.
Okay.
They can force the company into bankruptcy to recover what they're owed.
Wow.
Equity holders, on the other hand, get wiped out in a bankruptcy. Their call option expires worthless.
Wow. This options analogy really sheds some light on the relationship
It does.
between debt and equity.
Yeah.
It explains why debt holders are typically more risk-averse
Exactly.
than equity holders.
Yeah, they have different incentives.
But you mentioned something earlier about credit default swaps.
Yes.
Or CDSs.
Yeah.
Where do those fit into all of this?
CDSs are a fascinating and somewhat controversial instrument.
Okay.
They're basically insurance contracts on a company's debt.
Okay.
So let's say you own a bond,
Mm-hmm.
but you're worried about the company defaulting.
Okay.
You can buy a CDS on that bond.
Okay.
And if the company actually defaults,
Yeah.
the CDS seller pays you offsetting your losses.
So it's like a way for bondholders to hedge their risk to like transfer
Exactly.
the potential losses to someone else.
Exactly. It's risk transfer.
But I've heard that these things played a role in the 2008 financial crisis.
They did.
How did that happen?
That's a story for another deep dive.
Okay.
But in a nutshell, the problem was that CDSs allowed investors to bet on the creditworthiness of companies without actually owning any of their debt.
Oh.
So this led to a massive market for CDSs that wasn't transparent and wasn't properly regulated.
Okay.
When the housing market collapsed, it triggered a chain reaction of defaults that spread through the financial system, amplified by the interconnectedness of these CDS contracts.
Okay. That's enough to pique my curiosity. We'll have to revisit that another time.
Yeah, we should.
But getting back to this idea of viewing debt and equity as options.
Yes.
You mentioned that we could use actual option prices to estimate things like the interest rate a company would have to pay on its debt.
Yes, we can.
Can we see that in action?
Absolutely. Remember that hypothetical Google debt scenario we discussed earlier?
Yeah, back when Google didn't have any debt.
Exactly.
Yeah.
Back in September 2012, Google didn't have any debt, and their stock price was around $700 a share.
Right.
Let's imagine they decided to issue a massive amount of bonds, say $163.5 billion.
Okay.
Using options, we can actually get a sense of what interest rate they would have had to pay.
Okay. I'm intrigued. Walk me through this.
All right, so remember how we said that equity can be viewed as a call option on the company's assets?
Yes.
Well, by looking at the prices of call options on Google stock,
Uh-huh.
with a strike price equivalent to the debt per share,
Okay.
we can estimate what the market thinks Google's equity would be worth after taking on all that debt.
So we're basically using the options market to get a sneak peek at how the company's value
Exactly.
would be split between debt and equity after the debt issuance.
Precisely.
Okay.
And based on the option prices back then,
Yeah.
it looks like Google would have had to pay what's called a credit spread of about 3% on top of the risk-free rate.
Okay.
That's the extra interest they would have had to pay to compensate lenders for the risk of lending to them, even a company as financially solid as Google.
Wow. 3% on $163.5 billion.
I know.
That's a huge amount of money.
It is.
It really highlights how option prices can provide valuable insights
Oh, yeah.
into real-world financial decisions.
Absolutely. And here's where things get even more interesting.
Okay.
This whole options framework also helps us understand those conflicts of interest that often arise between debt holders and equity holders.
You mean those classic conflicts where equity holders want the company to take big risks
Exactly.
and debt holders prefer a more cautious approach?
Precisely. Remember, equity is like a call option.
Right.
So equity holders love volatility.
Okay.
The more the company's value swings around, the greater the chance of a huge payoff for them, just like with that call option.
So they're like those thrill-seeking roller coaster riders hoping for the biggest drops and climbs?
Perfect analogy. Debt holders, on the other hand, are like the folks who prefer a nice, calm carousel ride.
Okay.
They're happy with their steady interest payments, as long as the company doesn't go bankrupt.
Right.
They're not looking for those wild swings in value.
So using options to model a company's capital structure really helps us understand why these conflicts arise.
Yeah.
It's not just about personalities, it's about the inherent nature of their financial positions.
Exactly. And it's not just about understanding why these conflicts exist, but also about potentially quantifying them.
Okay.
By analyzing the sensitivity of option values, to changes in the company's risk and value. We can actually get a handle on how much debt holders and equity holders stand to gain or lose from different corporate decisions.
So it's like having a financial microscope that lets us zoom in on those
Exactly.
debt equity dynamics with like a whole new level of detail.
It's a powerful tool for understanding how companies are financed.
Right.
And how different stakeholders' interests align.
Or don't.
Or don't, exactly.
Wow, we've covered a lot of ground today.
We have.
We started with the basics of options,
Yep.
learned how to decode option payoffs, tackled put-call parity,
Yes.
and even saw how companies themselves can be viewed through the lens of options.
It's pretty amazing, isn't it?
It's been an amazing journey.
It really has, and I have to say, your enthusiasm is contagious.
Well, I have to give credit where credit is due.
Oh.
You have demystified a topic that seemed incredibly complex at first.
Well, I'm glad.
I feel like I've gained a whole new level of understanding.
That's what it's all about.
But before we wrap up, I have to ask, any final provocative thoughts for our listeners to ponder?
Here's one.
Okay.
If you could create an option on anything in your life, something that would let you manage risk or seize an opportunity, what would it be?
Ooh, that's a great one. I'm definitely going to have to give that some thought.
Yeah, it's a good one.
Thanks for that and for this incredible deep dive into the world of options.
You're most welcome. Until next time. So it really is a fascinating way to look at it. And imagine being able to quantify how much risk each side is willing to take.
Yeah.
It's like peeking behind the curtain of corporate decision-making.
So we're not just talking about like theoretical concepts here.
Yeah.
We're talking about real-world implications for companies and investors.
Absolutely.
That's pretty powerful stuff.
It is. And it all comes back to this idea of options as a framework for understanding risk and reward.
Right.
It's a mental model that can be applied to so many different situations.
I'm starting to see that we've covered so much ground today, from the basics of calls and puts
We have.
to this incredible insight into how companies are structured.
It's been a real deep dive.
It has.
And your enthusiasm has made it all the more enjoyable.
Well, I have to give credit where credit is due. You have demystified a topic that seemed incredibly complex at first.
Well, I'm glad to hear that.
I feel like I've gained a whole new level of understanding.
That's what it's all about, empowering people with knowledge and helping them see the world in a new way.
Before we wrap up, any final thoughts for our listeners to chew on?
Here's a challenge. If you could create an option on anything in your life, something to manage risk or seize an opportunity, what would it be?
Wow, that's a great one. It really forces you to think about how this concept of options can be applied beyond just finance to decisions we make every day.
Exactly. It's about broadening our perspective and seeing the world through a different lens.
I think our listeners are going to have a lot to ponder after this deep dive. Thanks again for sharing your expertise.
My pleasure. Until next time, keep those options open. Yeah, it really is a fascinating framework, isn't it?
It is.
Like, imagine being able to actually put a number on how much risk each side is willing to take. It's like you said, peeking behind the curtain of how these big corporate decisions get made.
It's not just theory anymore. It's like, real implications.
Real world stuff.
For people.
Yeah, for companies and investors and the whole 9 yards.
That's powerful.
It is. And it all comes back to this idea of options as like a framework for understanding. Risk and reward. It's a mental model you can take with you into so many different situations.
I'm starting to see that, we've covered so much ground today. From the basics of like calls and puts all the way to this incredible insight into like how companies are structured.
Yeah, it's been a real deep dive.
It has. And, I have to say your enthusiasm is contagious.
Oh, well, thank you.
I really feel like you've demystified a topic that seemed very complex at first.
Good, I'm glad.
I feel like I've gained a whole new level of understanding.
That's what we like to hear. That's what it's all about, empowering people with knowledge and helping them see the world in a new way.
Before we wrap up.
Any
final thoughts for our listeners to kind of chew on?
Here's a challenge for you.
If
you could create an option on anything in your life to manage risk or seize an opportunity, what would it be?
Whoa, that is a great one. I'm going to have to give that some serious thought.
That's a good one.
It really forces you to think outside of just finance.
It does.
And think about the decisions we make in everyday life.
Yeah, exactly. It's about broadening our perspective. Seeing the world through a different lens.
I think our listeners are going to have a lot to ponder.
I hope so.
After this deep dive, thanks again for sharing your expertise.
You're very welcome. Always a pleasure. And until next time, keep those options open.